to take you through a bit of a what if sort of situation now, because it's fine to sort of think about an asset being held for 7 years. But what if we actually sold the machine before the end of the 7 years? So what happens from a tax effective viewpoint when the asset that gave rise to the temporary difference is removed from both your accounting records and also from your tax records? So I've created some information about this machine. So let's say that on the 1st of July 20X3, which is the start of year 4, that I have a carrying amount of $12,000 and a tax base of 0. So look back at those numbers sort of that we had at the beginning. Let's say that I sold the machine for $7,000. So I need to look at, well, what's the difference on disposal? So if my carrying amount is $12,000 for accounting and I sell it for $7,000, well, I'd recognise an accounting loss on sale of $5,000. But that's not deductible, that's just something that gets recorded in my journal entries for accounting purposes. From a tax perspective, remember it was fully depreciated by the end of the 3rd year, so that's why the tax base was 0. But if I sell it for $7,000, there will be an assessable tax profit on the sale of $7,000. So how does that information get slotted in, firstly, to our current tax liability calculation? So yeah, here's my timeline again, just to give you an idea of what's happening. Now, I'm doing this, remember, at the beginning of sort of year 4. What I'm trying to show you here is that, well, at this stage, we don't know what the profit for the year is, but what I'm trying to show you there is that I'm adding back $12,000 with these 2 adjustments. And that's because the accounting loss of $7,000 isn't deductible for tax purposes, but the tax profit of $5,000 is assessable. So overall, when I would be calculating my taxable income, I've got this $12,000 add back. So remember that we usually perform these current tax liability calculations at the end of the year, the end of year 4. But if we did it on the 1st of July, there'd be this $12,000 add back. So for now, I'd just like you to understand that by selling the machine, the current tax liability will increase by $3,600. That is the $12,000 in add-backs there times 30%. So the current tax liability calculation at 30 June X4 will include $3,600 as a debit to income tax expense and $3,600 as a credit to the current tax liability. So what does this mean for our deferred tax liability on the 1st of July X3? Now remember that the temporary difference at the end of year 3 was $12,000 and that the deferred tax liability was therefore $3,600. We just saw that the impact on the current tax liability calculation at 1 July X3 will be an add back of $12,000, which will increase the current tax liability by $3,600. Something's happening here. We had a $3,600 deferred tax liability at 30 June X3, and this is reversing to become a current tax liability in the X4 year. This isn't a coincidence. This is what happens when the temporary difference reverses. We can see that the carrying amount and the tax base are both 0 on 1 July X3. Now that the machine has been sold, it's not our asset anymore, so there's nothing in our accounting balance sheet and nothing in our notional tax balance sheet. So looking at the deferred tax liability on this date, we can see that there's a debit movement of $3,600, which will fully reverse the balance in the DTL, bringing it back to 0. Now in practice, this entry will be recorded at 30 June X4, as our tax effect entries are recorded at year end. But I'm showing you this journal entry here so you can understand the reversal in the temporary difference that's taking place. So a debit to deferred tax liability, $3,600, and a credit to income tax expense. And that brings my deferred tax liability balance back to zero. The asset's gone, the temporary difference bit has, the asset, the machine, has gone. So therefore our temporary difference and deferred tax liability has gone. And that's what this journal entry is doing. It's clearing out that deferred tax liability balance. Now you may have thought that I've picked magical numbers there to make that work, but it really didn't matter what value I picked for the sales proceeds on 1 July X3. The difference between the accounting profit or loss and the sale will always be $12,000 different from the tax profit or loss on sale if I make the sale occur at 1 July X3 because of the difference in the temporary difference that was around at that date. So perhaps try doing a calculation in your own time using a different value for sales proceeds, or maybe even go to a different year, maybe year 5, maybe year 2, and just see what happens. But what you'll always find is that the temporary difference will reverse because the asset, the machine, is gone from both your tax and accounting records. Let's perhaps look at some key takeouts from what we've covered today by looking at my example with the machine. So we can use the formulae that you have in the CSG to help you determine the tax base and work out whether you've got a taxable temporary difference or a deductible temporary difference. So the formula that you've got in the CSG really does help you, but remember, use that gut feel as a bit of a cross-check. So we saw that a taxable temporary difference gives rise to a deferred tax liability, and that's what we had with the machine here. Whereas here we go, it's just too many letters. Whereas a deductible temporary difference gives rise to a deferred tax asset. So yeah, think about using that gut feel because it really can help you in an exam just to make sure that it's looking like it's going the right way. And your journal entries, what we saw there was that we are only recording the current year movement because remember, a balance in a liability or an asset account carries forward. And what we saw that with that machine was if we held it till the end of year 7, we saw the temporary difference reversing because it was fully depreciated for both tax and accounting purposes by the end of year 7. And we also saw that if I sold the asset at some stage during its life, again that temporary difference would reverse because the asset being removed from our books, the difference between its carrying amount and its tax base at that time will unwind by working out what your accounting profit or loss is on the sale compared with the tax profit or loss on the sale. So I hope this video has helped to clear up some of the complexities around temporary differences.